Okay guys, so I'm trying to do this in an orderly fashion. We've got the time frame analysis. You know what your time frame analysis is now. We've added the 200 moving average. That's our trend bias. Then we added the Fibonacci. We looked at why Fibonacci worked. We looked at sticking points on Fibonacci, and we looked at how to tailor the Fibonacci to our strategy, i.e. add the 618, nothing else. So step 4, understanding the stochastic RSI. So stochastic RSI is a momentum indicator. And it's one of my favorite indicators. How you get that is you just go to the indicators at the top of trading view and you can add in stochastic RSI. So you're adding in stochastic RSI. I've already got mine on there. So you click stochastic RSI and it'll come up and look something like this. So this is actually the RSI on the bottom. We're not going to be talking about this, but the RSI is like a real-time price action indicator. You can get clues from what price action's doing because that's buying and selling momentum, buying and selling orders. So you get clues from the RSI, but we're not going to go through the RSI because that's not part of this strategy. We're looking at the stochastic RSI and how price action follows the stochastic RSI. Now, I want you to think about this, guys. I want you to think about this when we're looking at the stochastic RSI. It's a momentum indicator. It's a lagging indicator. Let me just pull it up and explain exactly what it is. So it's an oscillating indicator, guys, and it tells you when the market is overbought or whether the market's oversold. So it indicates whether the market needs to cool off. It's not an exact science, but it's something that you can add into real-time price action, add into your existing strategy. We know exactly we need to pull back to the 618. That's telling us one thing. Price needs to pull back, so it's likely to drop the 618 and come back down to the 786 and test the 786 as this is pulling back. So we build this rule into our strategy to say that as price is pulling back to the 61.8% retracement, you've added your trend line in there, and we're going to talk about that next. You've added your trend line in there, and this needs to be overbought, i.e. under 30. Now, there's a thing that will happen time and time again, and this is okay to build this into the strategy, guys. So you come in it into overbought, right? So we imagine price actions pulling back. Let's have a look. Imagine price actions pulling back. Price actions pulling back, and price actions pulling back, and price actions pulling back. And then you're waiting for a break of trend. When you break trend, let me find a better example of this. So you're waiting for a break of trend. You're waiting for a break of trend. The stochastic's pulling back, the stochastic's pulling back. You can see at this point here, let me stick a line on there. That's when the stochastic is overbought, oversold. So the stochastic's oversold at this point, and then what's happening is we need to crack trend. Because we need to crack trend, guys, the stochastic is going to start pushing up. Momentum's going to start pushing up. So that's fine from the strategy, as long as we're not overbought, as long as we're below the 50. It's fine for the stochastic to pull up. Let me zoom in a bit. It's fine for it to pull up as we're going for the break, as long as it's not overbought. Actually, to be fair, it is overbought. You've broken here, it's overbought, so that's no good. What happened here? Price rejected. So because we were overbought at this level, that was indicating that price needed to pull back. Because price needed to pull back, we didn't have the momentum to break and start testing the previous swing high. We wouldn't have had a good enough risk to reward here anyway, because once you've got the break, that's below the swing low, tested for the previous swing high. That is a recipe for disaster. You've got all that risk and limited reward. However, if the stochastic had pulled back here, once we've broken, that would have shown that we've got more momentum, we've got more buying pressure, and it was likely to push up, at least test the previous high, but break and close above the previous high for a continuation. So let's just follow the stochastic along and see how price action reacts. And I want to split this in three, guys. You've got your bullish, you've got your bearish, and you've got your sideways. Now, trending is great for the stochastic. If you're bearish and you're trending downwards, stochastic works amazing. If you're bullish and you're trending upwards, the stochastic works amazing. If you're trading sideways, it's a recipe for disaster because the choppiness is chaos. When you're in a sideways range, trading patterns don't play out. You don't tend to put 5-wave moves in, up. You don't tend to do the 5-wave moves down. Doesn't play ball when you're in a sideways range, choppy accumulation range. That's because the buyers and the sellers are all buying and selling at the highs, buying and selling at the lows. So when you're at a choppiness, this is what's happening. This is sideways action. You can see pullback. You can see here, pullback. So you've got a pullback, getting these pullbacks. Can you see how price reacts to the stochastic RSI. So that's in a sideways range, guys. You're getting the pullbacks, you're getting the pullbacks. What's that doing to your P&L? If you were short in here, down to here, 12%, do you know that that's the low? Do you know that's going to react? Do you know it's going to continue to the downside? You don't know that. It's no good start just blind trading or looking for just things on the chart that you think might happen, guys, because when you're in a choppy range, that's when it catches you out. Ultimately, you break through the moving average, then you start trending upwards. So let's have a look at this when it's trending upwards. What does it do when it's trending upwards? You can see here, look. So when you're putting in higher highs and when you're putting in higher lows, this is a good signal, because what the stochastic does, guys, is it tells you once momentum or once the bears have pushed price all the way down, i.e. we're oversold, if we've put in a higher low when we're oversold, that's signaling that we're ready for a new push. If we're ready for a new push at a higher low, that's showing that you're at least going to test the previous swing high or potentially continue trend. So if you follow this, we'll go, when we start turning bullish is here. Start turning bullish here. So you've got a bit of a pullback, then the momentum really starts. This is what's happening on the stochastic. Then what happens, guys, you get to this phase here. Get to this phase. Stochastic's telling us overbought, need a little pullback. It's only a little pullback, but it gives a little bit of momentum for the bulls. Then what happens? All the way up. Stochastic's overbought at this point. Then we need to cool down. Where do we need to cool down? Here. Stochastic's telling us we're cooling down, we're pulling back in price. It doesn't look much actually, guys, but if you're taking profits here and then you're pulling back all the way here, that's dropping 33%. Stochastic's telling you you're overbought. Coming back and you're oversold. This is what I mean, guys. You come in here, you're putting in a higher high, you're pulling back, you're putting in a higher low. Now you're putting in a higher low. Stochastic oversold, signaling. Stochastic was oversold here. Stochastic's come back up here, all the way back down, it's reset, and it's reset on a higher low, signaling continuation to the upside. So using this in conjunction with price action is a good thing. It's a lagging indicator. It's a good indication to tell you whether you're overbought or oversold. So how is it going to work in our strategy? Let's go through it again briefly. You're putting in a higher high, coming back down, testing the 618, testing the 618 here. The stochastic at this point is either oversold or coming from an oversold. Then you're waiting for the break, you're waiting for the break, you're waiting for the close. The stochastic's got oversold or just coming from oversold. You've got the break, you've got the close, then you're adding in your risk to reward. You add in your risk to reward tool, and you want the minimum of risk, shooting below the previous low, and you're shooting for the previous high, 2.53 risk to reward. So that'd be a good example of something that you can take, because it's a minimum of 2.1 risk to reward. If it's 2.53 risk to reward, guys, and you've got a minimum of 2.1 risk to reward, and you do this over a period of time, you can analyze the data and you can see that these extra 0.53s do a lot to the P&L. It does a lot to the P&L, guys. So that was just a hypothetical example. But that's why we're using the stochastic RSI as our indicator. We're using it in conjunction with price action. We're using it in conjunction with the trend. We're getting clues that we've got momentum once we've got the break, i.e. the bears have kept price in trend, We know when the bulls have got momentum because they pop their head up through the trend. Once you've got that close, that means that they've confirmed momentum. You add in below the previous swing low, you're shooting for the previous swing high. And I'm going to continue to tell you this and tell you this and tell you this until you can tell me it back. So that's why we're using the stochastic, guys. That's why we're using the stochastic. So in the next video, we're going to talk about the trend lines, and then we'll be putting it all into practice.